The 7 investments that the government will pay you to make. So tell us about those.
The government actually gets more out of it than the taxpayer. So the fact that the government's giving incentives, this is not a loophole. These are not things that are unintentional. The government is actually making money on it. John F. Kennedy, back in the early 60s, did a test. And he said, if we give an incentive, at that time, it was for manufacturing equipment. If we give a small tax incentive, will we get more manufacturing equipment placed in service? That was really the goal, that we were in a bit of a recession, wanted to simulate manufacturing, and lo and behold, it worked. And I think it's pretty obvious as why it worked is because people hate paying taxes. So there's an emotional response to it, not just a monetary response to it. And so when I look at taxes, I'm going, okay, so by the way, that's why it's tax-free wealth, because that's an emotional topic, right? But what most people think is if the government wins, I'm going to lose. And the only way for me to win is to cheat. And so people who make a lot of money and pay little tax, they must be cheating. That would be the rich, right? That's why this whole thing about tax the rich, when in fact, that's not how the tax law works. The way the tax law works is, yes, the government will always win, but you can win also if you do what the government wants done, because there are so many incentives, 7 specific areas of the economy, where if you invest directly into those incentives, the government will literally pay you by reducing other taxes. They'll pay you to make that investment. So that's kind of the idea behind it, Keith. And then I would say, the second idea is you really have a choice. You can be a silent partner with the government. You can be an active partner with the government. But the fact is, you're a partner with the government. So just choose which one you're going to be. You're going to be a silent partner, pay a lot of tax, or an active partner and pay very little tax.
So I think we all want to be an active partner. And since the subtitle of your book is 7 investments that the government pays you to make, I know that 3 of those are classics: investing in food, housing, or energy. Tell us about some of those other 7 investments that the government will pay you to make.
Well, here, business is number 1. Business is by far, and this is around the world. So we looked at 15 different countries. We actually have 150 endnotes for 15 different countries. So the last 60 pages of the book are endnotes to just actually show where we got our information. And what it turns out that business is the most incentivized by governments throughout the world. So business is very important. The second most incentivized besides agriculture would probably be agriculture, but then you would have real estate. Real estate's a very highly incentivized, whether it's housing, commercial property, et cetera. And as long as you add debt to it. Now, real estate gets tax incentives whether you have debt or not, but that debt can multiply those incentives, and it multiplies the tax benefits by 3, 4, 5 times, depending on how much debt you put, how much debt you use. You can multiply your tax benefits simply by using other people's money. So, those are a few. Technology is another one that people don't typically think about. But if you think about, okay, now who are the richest people in the world who haven't paid tax for the last 20 years? Well, that would be Jeff Bezos and Elon Musk, both high in the technology world. The reason that Amazon and Tesla didn't pay tax for the first 20 years of their existence is because of tax incentives. That's the reason. So yes, they lost money in the early years, but then they had research and development tax credits, even when they were making money, so that they actually paid little or no tax.
Now, you brought up the names of a couple of famous, really wealthy people, and there seems to be this sentiment out there. I don't know whether it's growing or not, but it's awfully pervasive, and that is one where people say tax the rich. And a lot of times the people that say that, I don't know if they have a complete understanding of how capitalism and economies work. I mean, you're talking about entrepreneurs here that took on risk themselves in order to create a job for you and create value for you.
I doubt that there's anybody who owns a home who doesn't deduct their mortgage interest. I'm sure they all do. That's a tax incentive. I'm sure there's nobody who sends their kids to college who doesn't take the education tax credits. So it's very disingenuous for people to say, well, the rich get these incentives and their incentives are bad. My incentives are okay, right? So for example, the last incentive that I look at in the book is retirement plans. Well, retirement plans, I think there isn't a soul on the planet that thinks, oh, this is a really bad idea. Oh, no, we shouldn't give tax benefits for saving for retirement. No, everybody is okay with that. That, interestingly enough, is the one investment where the government doesn't make money on it. The government actually pretty much breaks even, at least according to the numbers that I ran. Okay. So, the rich should pay more tax. I'm going, well, first of all, the rich pay all the tax. Okay. So the poor don't pay any tax. 50% of Americans pay little or absolutely zero tax. And the tax rates are such where you really have to make pretty good income to pay tax at all. And you could be making $100,000, $200,000 a year and still pay very little tax. So I think it's very disingenuous, frankly. This is why I wrote the book, because I felt like we needed to have this conversation. We need to kind of point out to the world that if somebody's very wealthy and they don't pay any tax, it's probably not because they're cheating. Now, are there rich people who cheat? I'm guessing there might be. But I will tell you this, rich people always have CPAs, and CPAs don't cheat. It's not in our makeup. We would lose our license over it. We would lose our livelihood. CPAs are the most honest people I know. So, to say that the rich cheat is to basically throw the CPA profession under the bus and say, well, you're either complicit in the rich cheating or you're stupid. Okay. So I take exception to both of those because I think that most CPAs are pretty smart people and they're doing their best and they're following the law. And so again, these are incentives. These are strategies that the government says, if you employ these strategies, we're going to contribute. If you don't employ the strategies, we're fine too. We're happy to take your tax.
We're talking with Wealthability's Tom Wheelwright. He's the author of a fresh new book called The Win-Win Wealth Strategy, 7 Investments That the Government Will Pay You. Now, chapter 4 of your new book, that focuses on real estate. And oftentimes one doesn't understand until they become a real estate investor that, my income, my rental income is taxed differently than my income from my day job. In fact, I pay a different effective tax rate on those two things. For example, one's day job income often has FICA, Social Security tax knocked out of it, and rental income does not. So talk to us about the difference in tax rate between income from a day job versus that from rental income.
Yeah, for sure. Rental income is not subject to Social Security taxes. So that's 12.3% that you're not paying.
12.3%. That's a big deal.
Big dollar. I mean, for a lot of people, that's more than their income tax rate. So on top of that, with depreciation, you're probably not paying income tax either. So you're not paying Social Security tax and you're not paying income tax. Whereas with your job, you're paying both income tax and Social Security tax. So we always say that the very first thing to look at when a new client comes to us is, how are you using your money? If you're spending it or saving it, you're probably going to pay tax on it. But if you reinvest it, particularly into real estate, agriculture, business, technology, if you reinvest it, you're not going to pay tax on it. So it's very much a choice that every one of us has the opportunity to make once we learn that we have that choice.
Now, your book touches on tax depreciation. You mentioned depreciation. I think a lot of people still don't understand the depreciation benefit for real estate investors. Tell us about it.
You're just getting a deduction for the wear and tear on your building, but it's not just the building itself, because remember, you also bought the land improvements. Now, in my case, landscaping doesn't last very long because I will kill it. Okay. My wife, it will last longer, but the government says it's going to last about 15 years. Same with your covered parking, same with your outdoor lighting, things like that. Those are land improvements, about 15 years. So instead of over 27 and a half or 39 years, like you would have to do with a building, you get to deduct it faster. And then the contents of the building, we all know, especially you have renters tend to be harsh on the contents of your building. And so the government says, well, that's probably going to last anywhere from 5 to 7 years. That's the most. What happened in 2017, though, is the government said, okay, for the next few years, we're going to allow you to deduct 100% of both your land improvements and the contents of your building in the year you buy the building and place it into service. So a lot of times that can be 20, 30% of your purchase price. If you get a professional cost segregation person to do a cost segregation on it, that's a lot of money. That means you could put down $100,000 on a $500,000 building and get a $100,000 deduction in the day you close on the building.
Amazing.
It's a huge number. And not many countries have that kind of a tax benefit for real estate. It is an enormous benefit. And people should realize also that we have a little window of opportunity right now because that benefit starts diminishing in 2023. So 2023, it goes down to 80%, 2024, 60%, and then 2025 and after that, 50%. So we do have a window of opportunity right now. If you're thinking about what do I do with my money to keep up with inflation, real estate might be a good option.
Okay, we're talking about the bonus depreciation benefit sunsetting. offsetting over time. Tom, why don't you talk to us about just the basic depreciation benefit? Maybe it's easiest to use an example of, say, a $140,000 rental property where the improved portion of the property is worth $100K and the land is worth $40K. How does tax depreciation work?
Well, again, your bonus depreciation, you're probably going to get about 20,000 of that, 20 to 25,000 right off the bat. But then remember, you still got the building. And let's say your building is 50% of that, or $50,000. Well, that means that you're going to get about 3.5% a year on that $50,000, which is about $1,750 every year. You're going to get a deduction for $750, even if the building is perfectly good after 27 and a half years. So it doesn't matter whether it actually wears out. You get the deduction. And by the way, it doesn't matter if it's a new building or a used building. The US is unusual that way. A lot of countries only give you depreciation once. That is on a new building. They give it to you, but on a used building, you don't get it. We actually can get depreciation over and over again because you can take depreciation. Then when you sell it to me, I can take depreciation. And because of 1031 exchanges, you don't necessarily have to pay tax on that gain.
Sure.
I still get the deduction. So we literally can take depreciation deductions multiple times from multiple investors.